Good afternoon, everyone, and you're all very welcome to Deloitte's webinar on the latest amendments for Irish and UK GAAP reporters. For those of you who don't know me, my name is Brian Murphy, and I'm a partner in our Audit and Assurance department, working predominantly with the firm's private clients. I'm been joined by our panelists today, Claire Ryan, who's a Managing Director in our Audit and Assurance department, again focused on working with our private clients. Dave Hegarty, who's a Managing Director in our Valuations team, and also Dimpna Cassidy, who's the Director in our Financial Reporting Advisory team. I'll be your host of this panel here this afternoon. The plan for the webinar is to walk you through the key changes in Irish and UK GAAP, and the aim of the panel discussion really is to share some insights from an audit, evaluation, and an accounting perspective, which hopefully then will support you when you transition these changes to your financial statements. Just some housekeeping. Firstly, we will have a short Q&A at the end of the webinar, which will give you an opportunity to ask any questions that you may have on these changes. Secondly, we'll also have some Zoom questions throughout the session. And then thirdly, the webinar is being recorded. A bit of context then to the session this afternoon. Irish and UK GAAP, as you're well aware, it's a suite of frameworks that are applied to a significant number of incorporated entities in both Ireland and in the UK. This incorporates all of the standards from FS 100 to 105. So just taking those in turn, in terms of, I suppose, expected changes. Firstly, FS 100, which is the application standard, so the application of financial reporting requirements, minimum changes in terms of that standard. Similarly with 103, which is the insurance contract standard, and also similarly in terms of 104, which is the interim financial reporting standard. From a 103 perspective, a big question will be how IFRS 17 insurance contracts, which is the new insurance standard in IFRS, will impact upon FS 103. Currently, no changes are going to occur. And we assume here it will be to ensure that there is greater alignment between IFRS 17 and FS 103, which will happen in the future at some point. We assume a reasonable expectation here being that the FRC will wait a few years to see the lessons that they learn from the implementation of IFRS 17. But something to watch out for, certainly, if this is a space that you work in. FS 101 is the standard, obviously, which is reduced disclosures on IFRS, and it follows the annual review of IFRSs, and we won't be covering that particular standard in the session today. So the sessions which we will, are the standards which we will predominantly be covering and talking about today are 102 and 105. So the significant changes are in FS 102, and there are also some changes for FS 105 for micro entities, particularly when it comes to the recognition of revenue. These changes are effective from the 1st of January 2026, and there is earlier adoption being permitted on these changes also. So I assume everyone that's on the webinar has some familiarity or has some knowledge of the fact that there's some changes coming down the tracks. So we want to just firstly run a poll to see how ready are you in terms of the new amendments to FS 102. So just going to give 30 seconds, if you wouldn't mind just selecting your options. And we'll see how many we have in the first bucket, which is yes, you're all set. Just give it a few seconds. Okay, so probably not unexpected. So we have 56% not ready at all. So this is definitely a good start. And I hope by the end of the hour, you will also be well more set. And we have some who have started and some making great progress. And well done to the 4% who are well set. Maybe you might have a few suggestions and a few scenarios you can share with the group as well. So I suppose bringing us then into the meat of the session. Dimpna, we might start with yourself first. In terms of just talking us through some of those significant changes in FS 102.
Yeah, for sure. Thanks, Brian. So I suppose to start off, and before we delve into those significant FRS 102, 105 changes, it probably makes sense just to reflect from an IFRS perspective on some of the significant changes that have happened there and what the link is with the periodic review that the Financial Reporting Council has just done. So anyone who is familiar with IFRS or who sits within an IFRS group, it obviously has been there has been quite a few big standards that have come in. So between revenue, financial instruments, which were effective 1 January 2018, and then just a year later, you had the whole new leasing standard as well. So huge change. And I suppose from the perspective of FRS 102 or Irish GAAP being simplified versions of IFRS, it is still really important that they're staying up to date with those changes, especially when they're significant from an IFRS perspective. So from that point of view, the periodic review you can see is very much focused on leasing and revenue. But there are obviously some other clarifications and some other narrower scope amendments, which again are kind of supporting that alignment to IFRS. So overall, quite positive and great for comparability purposes as well. I might just start off with financial instruments, mostly because this is a lesser impacted area when we compare that to leases and revenue. So Section 11, which is basic financial instruments in FRS 102, and Section 12, which relates to other financial instrument issues, is broadly unamended as a result of this periodic review. There is two critical points, though, I might just flag. And the first one is in relation to the accounting policy choice that sits within the financial instruments guidance within FRS 102 that allows reporters to use the recognition and measurement guidance of IS 39, which was IFRS 9's predecessor. Now, you would have had to use the disclosure requirements of Section 11 and 12, but on a go forward basis, that optionality is going to be removed. So just something to highlight to people. And equally, then, another interesting point, which is really topical, and that's in relation to the expected credit loss model. So, again, reporters who are using that accounting policy choice, which is permitted for FRS 102 reporters to do the recognition and measurement of IFRS 9, would be very familiar with this concept. However, for those outside of that accounting policy election, there is no change, and the expected credit loss model hasn't been brought over as part of this periodic review. But I do think that that's something that maybe is important just to keep an eye out for. Potentially, maybe even the FRC might look at a separate project for that particular topic because it is very topical. Then just maybe moving into leasing. The bad news is for those with large operating lease portfolios in particular. So we'll see a huge change there with a lot of leases now having to be brought on balance sheet. So it's moving over to that IFRS 16 single model where you're bringing everything on with limited exceptions. And those limited exceptions are things like if it's a short-term lease or if it's a low value lease as well. And I think probably the best way to illustrate the impact or the potential impact is through an example. So I might just ask for the slide to just appear there. So that's great. Thank you. So in this scenario, we have a lessee who's leasing a building for a period of 3 years. They have a rental charge that's annually 56,000. And we have assumed for simplicity of the example that the discount rate is 4%. However, I know Dave and Brian, you'll get into a bit more detail on complexities that can apply in relation to discount rates. So I suppose from an operating lease perspective, applying the current Section 20 guidance, the expectation would be that you're just recognising a rental expense as part of your profit and loss account, potentially within your operating expenses. However, unless the lease qualifies as low value or short term, you would now be expected to bring that on your balance sheet. And that's going to result in you recognising both a lease liability and a right of use asset. So a very big change in particular for your balance sheet. And the lease liability will be the present value of the future cash flows. And that will be unwound back into your profit and loss accounts through the interest expense. And equally, it'll be reduced by the cash rental payments that you're making out to the lessor of the contract. And then just in relation to the right of use asset as well. So from the right of use asset perspective, you'll now have this on balance sheet as well, and this will need to be depreciated over the life of the lease. And generally, the starting point for your right of use asset is actually your initial lease liability amount, but there could be some adjustments that you need to make there. So maybe then just focusing in on some of the simplifications as well. So the simplifications are pretty much aligned to IFRS 16 in the fact of the critical ones are in relation to that low value amount. And just maybe to clarify some of the differences that you would expect between an IFRS reporter and an FS 102 reporter that has transitioned into this FRED 82 environment is that there's no explicit threshold that's been included in the accounting guidance. There is, however, examples that have been included around what is something that would not qualify or what is something that would qualify. So it does bring an element of extra judgment, but it, I suppose, also does bring that element of a little bit more flexibility as well. And then just a final point in relation to leases, just from a transitional perspective. So positive news there again in the fact that you can use a cumulative catch-up approach as opposed to a fully retrospective approach to transition. And equally for those entities that do have FRS 102 reporters within an IFRS group, there's scope for you to use those IFRS 16 numbers as the opening position for transition.
Great, thanks, Dimpna. So I think, look, it's pretty clear there is a bit of work in terms of transitioning your new lease accounting, particularly if you have a large portfolio of leases that are currently classified as operating leases. And we are certainly, I think, having those conversations with our clients, particularly those, for example, in the retail space, who might have significant operating leases currently only working through their profit and loss. And I think, I suppose, the kind of conversations also been had, there is wider impacts of this. It's not just an accounting change. This is having an impact on certain ratios. It's having impacts on, for example, debt covenants. So certainly there are conversations that, you know, our clients are currently having, for example, with financial institutions to just, I suppose, bring them up to speed in regard to that. And also, I suppose, the other, I suppose, reality is, you know, IT systems need to be considered and looked at, and also controls around this, because, you know, there is quite an element of process that needs to happen to ensure the correct controls are kind of put in place and around these leases. So important, I suppose, that that's all done from the outset and from the beginning. I think, as you touched on, Dimpna, you know, certainly one of the complexities is around the discount rate, and we currently obviously already have that in IFRS 16, in the IFRS 16 world, but there is simplifications in terms of what you can use in terms of that discount rate. So, for example, you know, one of the key simplifications here is that you are permitted to use an obtainable borrowing rate as an alternative to using the incremental borrowing rate, which is what I suppose is described and set out in IFRS 16, where the rate implicit in the lease cannot be readily determinable. And certainly that's something we expect clients to use a little, particularly if it is, I suppose, difficult if they don't have necessarily the lease documentation from a number of years back and so on. And in very rare circumstances where the implicit rate or the IBR or the OBR cannot be determined, there is permission also then, I suppose, to look at maybe other kind of alternatives. So as I suppose some of the IFRS groups may be using IFRS 16 numbers as their opening balances, maybe let's start with how you might develop that implicit rate or the IBR. Dave, maybe coming across to yourself, what do you see as being the key challenges that IFRS 16 reporters dealing with developing this discount rate are going to have from a valuation perspective?
Yeah, sure, Brian, and nice to speak to everyone. I suppose just to take a step back initially and maybe go through the IFRS 16, you know, the calculation of the discount rates under that standard. And the initial directive is to use the rate that's implicit in the lease, and people are probably familiar with this, but that's the discount rate that if you take a point at the inception of that lease, this rate results in the present value of your lease payments and your residual value. It sets those quantities equal to the sum of the current fair value of that leased assets and any initial direct costs. Now, that, as I said, that's the starting point, the rate that's implicit. However, the calculation of that rate can definitely be challenging, and we see that across our client base. And for example, things like the residual and even the current fair value of the asset itself can be difficult to determine and to conclude upon reliably. So what the standard allows for in that particular case is if that implicit rate is not readily available, the use of an alternative is allowable, and that alternative is known as the incremental borrowing rate, or the IBR, we'll call it going forward. So this IBR is the rate of interest that a lessee would have to pay to borrow over a similar term and with similar security the funds that would be necessary to purchase that asset in a similar economic environment. So While that sounds relatively straightforward, it's actually not, and can be quite challenging to perform that calculation. It can actually require a significant amount of data. The first starting point is a credit assessment, for the lessee themselves, or initial, or to come up with an initial kind of anchor borrowing cost. And then you're into a situation where you need external data, such as perhaps benchmark yield curves that you might need to use as a proxy. There's also be considered, and you'll have noted maybe from my description of the IBR, it's on a secured basis. So you may need to apply a security adjustment to the borrowing rate that you're using. And there are other adjustments also that need to be applied, such as country risk, and there are other adjustments also. So it's not a straightforward exercise to calculate the IBR, and I think from that perspective, Brian touched on the OBR, the obtainable borrowing rate, and that's probably a welcome alternative for under FRED 82.
Yeah. I think we should also apologize, I think, for all the acronyms. So there's so many acronyms in this particular standard and getting your rates mixed up. So, taking that point in, Dave, right? So I suppose, we would suggest we kind of start out with an implicit rate, or the IBR being the incremental borrowing rate. However, if not available, then you talk about the obtainable borrowing rate. So how would the value maybe potentially compare there, as opposed to using the implicit or the IBR rate?
Yeah. So just to go back in terms of the pattern, your first point is to use the implicit rate. If that's not readily obtainable, you have a choice then under FRED 82, where you can either use the IBR or this obtainable borrowing rate. And just to touch on the detail of the obtainable borrowing rate, this borrowing rate is the rate of interest that you'd have to pay to borrow over a similar term, an amount equal to the undiscounted value of all the future lease payments. So this is different to the IBR in that this is really how much it would cost to borrow a certain amount of cash, essentially, rather than borrowing to fund the purchase of an asset. So it's a broadly similar concept, but the obtainable borrowing rate is expected to be simpler, and it represents a proportionate simplification relative to the calculation of the IBR. The initial draft of FRED 82 also pointed towards the possible use of gilt rates, but that in the latest version of FRED 82, that is off the table. So I think what you're really looking at is a choice. If you can't use the implicit rate, it's a choice between using IBR and, in my view, the more simplified obtainable borrowing rate.
Great. And so in reality, probably one of the questions we're being asked is, is there really differences between all these different rates, like in real terms?
Yeah, and it's a fair question, and I suppose my answer, like a lot of my answers to your questions, Brian, is it depends to an extent.
Yeah.
In this particular case, if you're looking at the difference between the incremental borrowing rate and the obtainable borrowing rate, everything else being equal, I would say the obtainable borrowing rate will be slightly higher, just because it's not calculated on a secured basis. But I think that's very much on a like-for-like basis, and there are a lot of other considerations as well. So I'd expect to see some fluctuations there in different cases.
Great. Yeah, perfect. Thanks for Dave. So Claire, maybe just from your perspective, one of the questions I suppose clients will probably ask is, from an audit perspective, what is this that the auditors will look for, and what will kind of, I suppose, the focus be?
Thanks, Brian. Yeah, so I think from an audit perspective, when we look at the leases, obviously a big piece of it will be obviously how much value and what's the size of your portfolio from a lease perspective, on how much audit work we'll need to complete on it. I think even from obviously listening to David there around the discount rate, there is lots of element of kind of estimate and judgment in that conclusion of what discount rate you use. And I think that will be the key area of focus from an audit perspective. I think overall, we will obviously still need to do some standard audit procedures. So making sure we're getting ourselves comfortable that, the lease calculation as a whole is kind of complete and accurate. So, very simple audit procedures around, checking the accuracy of it, performing recalculations, selecting samples and agreeing back to supporting lease documentation, so that on an overall level, we can be comfortable with the calculation and how it's being completed. I think the discount rate was where we will spend the majority of our time from an audit team perspective. And I suppose what I would be expecting to kind of see from the client is really that they have kind of done that assessment and really prepared a detailed memo about how they have got to the discount rate that they have used. And I think a big part of that will be including your auditor as part of that process, and as you were talking through it, including them in that discussion so that the challenge or any differences in opinions comes through that process rather than at your year-end audit, causing delays or issues. And I think the key part for our side will be there is that estimate and around the discount rates. So we will probably have to include maybe some of the evaluation team on our side to help us kind of get to the conclusion that we are happy that that discount rate and the valuation work is appropriate. So again, including us earlier allows us to bring our specialists on earlier as well. So again, giving good feedback and making sure that kind of ahead of time, we're quite comfortable with the lease calculation as a whole and that the discount rate applied really is appropriate.
Thanks for that, Claire. Dim, that might just there's just one question just that we might just address on leases now, if that's okay. And it's really, I suppose, how do you expect FRS 102 reporters to deal with assets that are not listed in the low value recognition exemption guidance for leases? Like, is there a judgment involved in that process?
Yeah, I think that's actually a very good question, because this is one of the distinctions between IFRS 16 and what's proposed here by the FRC for FRS 102. So what is provided is just that list of examples. And, so anything then that's sitting outside of those examples, it does require that element of judgment. But I would probably see that as being something quite positive, in the fact of there's probably a little bit more flexibility than if you have a very explicit threshold. So it's really around rationalizing, and if you take that step back, is this actually something that is in essence low value, and can I stand over the fact that I haven't brought it onto my balance sheet? And again, it's probably linking then back to some of the points Claire has mentioned around, getting your auditors on board and potentially developing some level of policy around what you plan to do based on the specifics of your business.
Yeah. Okay, no, thanks for that, Dimple. Yeah. So I mean, I think kind of wrapping up maybe on leases, certainly there's going to be a challenge and a piece of work to be done around those discount rates, making sure you have a clear, definitive list of what those leases look like, and that from an audit perspective, I suppose, we'll be focusing in on the lease, the agreements, the calculations, but it's really, I suppose, that focus around the rate is what's going to be most important to us. I might then move on maybe to the second, I suppose, maybe key focus area and where the kind of significant changes are. Dimple, I might come to you as well here first, which is around revenue. So you might just, I suppose, touch on some of the kind of key aspects of this and how it will impact.
Absolutely. And I suppose the first point of note here is that leases only impacts FRS 102 reporters. The revenue update is impacting FRS 102 and those micro entities applying FRS 105. But I suppose, again, on a positive note, there is quite a lot of proportional simplifications that have been captured as part of this amendment. And equally then there's enhanced simplifications for those micro entities as well. So definitely something that's worth looking out for and seeing how that can apply to you. I think, again, I'm going to rely on an example to illustrate the points and the differences here. It's just, so here we have two companies. We have Company A and Company B. And Company A is in the business of selling machines with a unit price of 35,000 kh, basically. And if we were sitting in our current Section 23 environment, what we would do is we would assess, is this the sale of goods or is this the sale of services? And in this scenario, this is the sale of goods. Therefore, we would expect that we would recognise our revenue at a point in time whenever the risks and rewards of ownership are transferred over to the third-party customer. And then just the other lens that you would see from a Section 23 perspective is that scenario of where you're providing services. So Company B is in the business of providing professional services to customers. And what we would expect then from a Section 23 perspective is that that revenue would be recognised over time and to the extent to which the services that they've been obligated to perform have actually been completed. So a completely different view and different lens is needed when we move over to this new FRED 82 environment from a revenue perspective. And the fact there's a single model that has 5 steps that each of your contracts would need to be processed through. So just having a look on the screen and kind of chatting through those steps. So the first step here would be around the identification of a contract. And there's quite a lot of subtopic information required there. So do you actually have a legally enforceable contract in place, for example? You then move on to step 2, which is looking at the identification of performance obligations. And this is really critical in the sense of ensuring that you're recognizing your revenue at the appropriate timing. So, whether it needs to be at a point in time, over time, and if there's particular parts of your contracts that need to be recognized on different basis. Then as part of step 3, this is really around the determination of the transaction price. So providing you with additional guidance in relation to concepts maybe like variable consideration, fixed consideration, and making sure that you are appropriately identifying the consideration attached to the contract. And then step 4 is you looking at basically using the work that you've performed as part of step 3 to identify the consideration and apply that to the performance obligations you've identified as part of step 2. And then finally, you get as far as step 5, and step 5 is really looking at whether you need to recognize revenue at a point in time or over time. So it's a very, very different approach and a different lens of thinking as well. Now, just to mention some of the simplifications. So there is simplifications that's being offered as part of what's been moved into section 23 as a result of FRED 82. And one of the points I might call out is in relation to the cost of obtaining a contract. So this can cause challenges for IFRS 15 reporters in identifying those amounts and the accounting for them. There's an accounting policy election for reporters within Irish UK GAAP, and that basically means that you can choose to capitalise or to expense those amounts.
Right, Emily, thanks for that. And I think just also sticking just in terms of other, I suppose, points around the simplifications. So unlike with the option that we have in leases, that does not exist here in that certain companies. So for example, clients and companies with contracts with customers over a longer duration, they may find that they now have differences when they now bring in the changes here that are now under section 3 or section 23 of FRS 102 to the IFRS group numbers that they have for consolidated purposes. So it's just something to kind of just watch out for and to bear in mind. And also, in addition, from a transition perspective, either the fully retrospective or a cumulative catch-up approach can be used. And then micro entities can simplify again and apply the revenue requirements just prospectively from the data change. So again, that's important, particularly from a micro entity perspective. I suppose the leases and revenue obviously coming out is the real, I suppose, game changers in terms of what is up for amendment. But are there any other, I suppose, changes that are worth kind of noting?
Yeah, and I might just ask if we could move to the next slide, please. That's brilliant, thank you. So there are other changes outside of revenue and leases. We've covered some of these or mentioned them already, but I might just pick out 2 in particular. So from a section 29 perspective, which deals with income taxes, there's some additional guidance being incorporated there, which is coming from IFRS's IFRIC 23, which deals with uncertain income tax treatments. So again, I think that would be quite welcomed in the fact that it's additional guidance. And the other piece that I might mention is in relation to supplier financing arrangements. So the ISB did make some updates to IFRS in relation to the expectations around the disclosures that are required for those types of transactions. And the FRC have also made some updates to FRS 102 on this point. Just to flag, I suppose, that the critical changes are around the quantitative and qualitative information that reporters should be including around these transactions, and to note that there is difference in the effective date. So the supplier financing arrangement requirements is effective a year earlier than the overall FRED 82 requirements, which is 1 January 2026.
Great. Yeah, I suppose a few other maybe points just on the screen worth noting. Section 2A is new and it's really, I suppose, bringing the guidance of fair value into the main body of the framework. And I think that will give it a bit more prominence. The definition of the fair value is basically been brought across from IFRS 13, and there's definitely more guidance there in terms of valuation, which I think will again provide a bit more alignment with what's in the IFRSs. The other, I suppose, amendment to just, I think, note is in regarding share-based payments. So not going to be relevant to everybody, but for anybody it is relevant to. There is now a requirement to measure the fair value of your liabilities that arise from cash-settled share-based payment transactions. And that has been added, as well as requirements for the settlement of an equity-settled share-based payment transaction by the entity transferring cash or any other assets. And then again, they've updated in terms of the standard, the fair value, which aligns then to what's in section now 2A. Dave, just on that, so I mean, there are items there that could, I suppose, potentially result in additional valuation considerations. You might just maybe share some insights around that for us.
Yes, Brian, there's two main points you touched on there, and the first one is just in relation to the alignment of fair value with IFRS 13. So the main consequence of this really is that, you know, liabilities, it's based on transfer value rather than settlement value. So liabilities are based on their actual transfer value rather than their settlement, rather than the settlement amount. And what this means is that adjustments for a credit risk will become far more common and far more significant. And that brings quite a number of challenges. I guess in the case of, you know, if you're measuring credit risk, it's very rare that there's observable market employed measurement of your credit risk in the market. So it's a case of estimating credit risk using proxies or using maybe a lending facility that you have with a lender, using that to infer your own credit risk, and that brings challenges. It's not straightforward and may require some external data as well if you're thinking about using proxy curves, etc. The second point, Brian, that you made was just in relation to share-based payments, and there's a very wide range of complexity in terms of the calculations of share-based payments. Can range from the very vanilla through to very complex models that require you know, option pricing techniques to be applied. And even in the simplest case, you would need to be aware of items like maybe, you know, discounts that you might apply, liquidity discounts that might need to be applied to even the simplest of calculations. So there are some considerations there. Fair value of such share-based payments, as I say, there's a wide range of complexity, but it certainly brings a new layer of possible complexity to that area as well.
Great, no, thanks for that, Dave. Claire, maybe just a question for yourself. Just a question that's come through here is in around on revenue. We talked about, I suppose, from an audit perspective, what we might require there from a leasing perspective. But when you take revenue, any thoughts there in terms of kind of, I suppose, key challenges or things for the clients to watch out for?
Yeah, I think the revenue one is interesting because it will have different impacts on different entities and what kind of types of revenue they have. So I suppose from an audit perspective, ultimately we'd be expecting every client to do that assessment where they're obviously going to take their material kind of, you know, revenue streams or contracts and complete an assessment of each step to determine is there any changes in the way that they're recognizing revenue. And the answer for that will be different for different entities. So, you know, ultimately some may end up in a position where there isn't much changes to the way they're recognizing revenue, but there may be others where there is some more maybe complexities or nuances in some of the revenue streams that they have, which will lead to more change with regards to how they recognize revenue. So from an audit perspective, a bit similar to the leases, but that initial assessment done by the client and going through those key steps, it will be important again to include the auditor as part of those processes. So again, that everyone can be aligned on the conclusion of what way revenue is actually recognised now in line with the new standard.
Okay, thanks, Claire. We might just at this point, we might just run a second poll if we can, please. And this is really, I suppose, happen kind of now hopefully have an idea of what the kind of changes look like. Which area of the latest amendments will be the most challenging, do you think, to implement for your business? We've obviously made assumptions based on what we've said and how we've discussed with our clients, but just to make sure we're getting it right. So I'm going to give you 30 seconds. Okay, just give us a few seconds. Okay, yeah, so probably again, as we kind of had expected, leases coming out with 57%, 25% then on revenue, and then fair value, and then really disclosures then coming back back then 15 and 15. So any thoughts on that, Dimpna? I don't think it's anything that we weren't expecting.
No, I don't think so. And I expect, it's probably around kind of looking at that, how you're impacted. So if you are someone who's sitting with a large operating lease portfolio, then absolutely your focus is going to be on leases. And in some instances, probably some of the experience we have from those who transitioned from IS 18 over to IFRS 15, where IS 18 would probably be broadly more aligned with the current FS 102 standards. We didn't necessarily have huge impacts, but some industries would be more impacted than others. And equally, you still have to go through that process with that updated lens of the 5-step model.
Yeah. Okay. Yeah. All makes sense. Thanks, Emma. I might just go. So we have a number of questions currently in the panel, so I might just address a few of those now, if that's okay. And just to remind everybody on the webinar, if you do have any questions, please do put them into the Q&A box, and we will obviously won't get to every question, and there may be 1 or 2 questions where we need to kind of get back to people, but be assured between today and a follow-up, we will endeavour to answer all the questions that are here. And Dave, if you wouldn't mind, I just might go to you first. There's just 1 or 2 questions around valuation work. So we've all probably touched on the discount rate for leases. So the question really is, what level of information would you require to support valuation work on discount rate for leases as a result of, I suppose, what everyone's heard about this morning?
Yeah, certainly, Brian, and I think Claire touched on this to some extent as well earlier in the webinar. But I think what we're really looking for is a very clear documentation of, first of all, the decision process about what path you're going down in terms of what rate is being selected. Are you using the implicit lease? If not, why? And then if you're moving on, and then you're selecting between the IBR and the obtainable borrowing rate, and just a very clear decision path there. And then we're into some of the items again that Claire touched on, where you will want to see the quantitative calculations. First of all, the support for the methodology used, and then the quantitative calculations as well, so that we can essentially, as an auditor, you can go out and you can independently verify that information. So I think we'd be looking at a relatively detailed paper just outlining how the rate was arrived at.
Yeah. Okay. Well, thanks for that. Dimpna, maybe just 1 for yourself, and it's just probably just clarification around dates. So I suppose implementation date, do we have to go back, prospective versus retrospective? You might just give the viewers just through that again.
Yeah, so something important is probably to look at the different transitional requirements that apply to each section. So for example, for leases, you can do the cumulative catch-up approach, which would mean you wouldn't have to restate comparatives. And equally, you have that simplification where you can take, say, if you have those IFRS 16 numbers sitting readily available, use those as your opening balances. From the perspective then of kind of other important dates just to be aware of, you should make sure that, say, for something like supplier financing arrangements, that you are realizing that the effective date is a year earlier than the wider FRED 82 amendments. And for any kind of specific kind of transitional pieces as well, the guidance in section 35, which deals with transition, has been updated to support you in making that move forward as well.
Okay, great. Thanks for that. Another question probably for maybe both Claire and Dimpna, but maybe Claire, I might go to you first. And that is just in terms, I suppose, if you've done nothing to date, right? So, I mean, if you look at the responses earlier, I think more than half of the people on the webinar haven't actually really started looking at these changes. First thing would be, I suppose, what are the first steps? I mean, what's your suggestion? What are you seeing with our clients?
Yeah, I think that initial piece is around, looking at those 4 or 5 kind of key areas of change at this point in time, high level, to just kind of determine, is this going to be really impactful for us? So example, like that you said, if you've got a portfolio that is quite large of leases, there is going to be a substantial amount of work, similar on that revenue piece as we discussed, or if you've got share-based payments, etc., and some of the other points to discuss. So I think the first instance is, even just after today, to just step back for 15 minutes, go through the 5 or 6 key changes and go, does that actually impact my business or not? And I think that second piece, which I know with all change comes, is around really looking at it as early as possible. But I think a key part of that, especially with, there's a lot of asks on finance teams lately with new changes and CSRD, etc., is really looking at your finance team and who is best placed to maybe look at these specific areas to complete those assessments, and what is a realistic timeline with everything else that's kind of going on in the background to kind of put in place. And then I think the third piece is, as I said, reaching out to those relevant people that should be part of that process, whether that's your auditors or if you need guidance from specialists, etc. Bringing them along as well at the same time should minimize, I suppose, the impact of this transition, or, as I said, misstatements or issues or errors coming up later in the day when you are getting close to that point of where you have to transition.
Yeah. Do you have anything to add from your perspective?
Just kind of the general point on the fact that FRS 102 is a simplified version of IFRS, and to really have a think about those practical expedients and simplifications as well. So, you know, it's good to do that absolute impact assessment, but then just maybe try to simplify the process for whatever works for your business as well.
Yeah, no, totally makes sense. Yeah, no, thanks for that. Again, just reminding everyone, if you have any questions, please do put them into the chat box, or the question and A box. We won't obviously get to answer them all, but we will endeavor to do so in this particular session. So just looking down through in terms of kind of questions, it's another kind of similar one, Dave, but it's just in around you know, there appears to be a few people on the call who do have cash settled share-based payments, and to look at the fair value work that would be done there. So I mean, in terms of kind of what are you seeing on the ground there in terms of support for any of your IFRS clients?
Yeah, and in a way, it's similar to the kind of support we'd look for the discount rate. So what you're really looking for is, you know, obviously the documentation around the share-based payment, you know, important that it's correctly documented, and then that the correct valuation approach is selected. I mentioned earlier there's a wide range of different kind of complexity levels for these awards. So just that, you know, you need to document which approach you've chosen, why you've chosen it, and why it's suitable in this particular instance. And then it would be an assessment of the input to the, you know, the inputs to your valuation model. And again, similar process so that they can be,
Yeah.
an auditor can validate those inputs. So it's a similar detail of documentation that we would require there. And in a lot of cases, a lot of our clients would use, you know, in the case of very complex awards, complex structures, they would tend to use external specialists in a number of cases.
Yeah, okay. Well, thanks for that, Dave. Dimna, just a question which kind of comes back to just the transition is around, you know, can you just maybe explain the retrospective versus the cumulative kind of approach and the difference between the two?
Yeah, sure. So I suppose the cumulative catch-up approach is really like a modified approach. So it's a simplification in the sense of you would look at what is your impact on transition, and you'd make that total adjustment against your opening balance as an equity transitional amount. Whereas I suppose if you're doing that fully retrospective, you're essentially going back to say, well, you know, if I had this contract from initiation, where would I be, and what would be the impact at that point in time? So that would be, I suppose, the critical differences between them.
Yeah, great. No, thanks for that. Again, continuing to just remind people, if you have any other kind of questions, please do put them into our chat box. While we're waiting on a few more questions to come through, just maybe your thoughts in terms of kind of key takeaways. So maybe Dimna, could I maybe start with yourself?
Yeah, so I suppose just kind of a word of warning from my side, in the sense of the exposure draft does have some differences when it's compared to the final version that was issued in March of this year. And actually, some of the things that changed was removing some of the practical expedients and simplifications. So just to be careful on, if you were in the detail of the exposure draft, just making sure that if you are planning on taking some of those, that they do exist in the final version of the updates. And then outside of that, just, kind of looking at your impact, looking at the transitional provisions and the simplifications that are available to try and make your transition as simple as possible.
Yeah, no, thanks for that, Dublin. Dave, maybe from your perspective.
Yeah, so looking, I guess, at the discount rate calculation and maybe the fair value calculation together, I would say probably the important thing is, maybe this is very self-explanatory, but to be well prepared for quite a complex what could be a complex calculation in some cases. A lot of share-based payments, as I referred to, we see a lot of our clients engaging external specialists, and actually we've seen that in terms of selecting IBRs as well. Now, Fred 82, I think, will be easier because you have the option of selecting between the IBR and the obtainable borrowing rate. But we do see clients using external help in those cases as well. So I think just to be prepared for the possible complexity that some of these changes are going to bring.
Yeah, no, thanks for that, Dave. Claire, from your perspective, kind of one or two key takeaways.
Yeah, I think I suppose engaging early is always the key part when it comes to these changes, but it is important, in particular maybe for some people who might be on the call, even from a revenue perspective in particular, and think, oh, I think our revenue stream is quite, simple. I actually don't think there will be any change. But, if you hold off on that assessment, sometimes things do come through that you haven't time to be thought through until you go through the 5 steps, which can result in more work. So definitely that engaging early and doing that initial assessment so that you can plan how much is needed and what people you need is probably going to be the most important thing really over the next while.
Yeah. Great. Well, thanks for that. Dimna, just a question here around, I suppose, the best guidance, I suppose, and kind of, I suppose, what's out there. I mean, there's a lot of, I suppose, different guidances there. Maybe you might just, I suppose, give us a few kind of touch points, and we will share that obviously with the audience afterwards as well.
Yeah, so I suppose the source is always the best place. So the documents coming from the FRC, and there's a marked up document which shows what the text was and what the changes are, which is very useful. I suppose I'd be hopeful that there's going to be a consolidated, clean version of that issued by the FRC, which would be a much more useful document for people trying to apply the transitional provisions. But as a starting point, that's definitely very good. And then equally, I would say that we do actually have some need to knows, which go through kind of the critical pieces that will definitely support in relation to that impact assessment that Claire mentioned as well. So those are two quite useful starting points.
Okay. No, thanks for that, Dimna. We might just we've one last poll that we might just run at this point if we could. I always find these questions interesting after you've heard 50 minutes of an update about accounting policies. But I suppose to get everyone's view around if they believe the latest FS 102 amendments will bring a positive impact for your business, and then why. There's obviously a few different options in terms of that why if you answer yes. So just good to get your thoughts around that. Again, we'll give you 30 seconds. Just waiting for it to come through there now. Okay, so I think, yeah, some interesting thoughts probably around this. So certainly, I mean, one of the clear messages we're getting from our clients is that it is certainly useful now that we're more aligned to IFRS. However, I suppose then that does have a follow-on question from some clients, which is, well, what's the point? But I suppose, to be fair, the simplifications are still there in the amendments, as are the, I suppose, more limited number of disclosures, which I think is certainly welcome when we compare the two sets of financial statements, IFRS versus FRS 102. There's still quite a significant difference between the two from a kind of a note perspective. 27% still unsure. I would say over the next kind of number of months, as you kind of start this kind of transition, hopefully that'll become a little bit clearer to people. So thanks for that. I think that's kind of a useful, just kind of from our perspective. One or two other questions, if I might, just before we wrap up, and Dimna's probably back just to the kind of guidances that you've already kind of referenced. I suppose people just looking for, you know, example or sample kind of calculations, for say the likes of kind of leases and revenue. I assume that's in some of those documents that you referenced earlier.
Yeah, so I suppose, like, for explicit examples to do with your specific scenario, like you're not going to find that, so you will have to just apply the guidance. I think even to get an understanding of how the concepts work, it's probably quite a good idea to have a look at some of the IFRS 16 collateral that's there as well, but just making sure that you're very conscious of the fact that FRS 102 is a separate framework with separate requirements.
Yeah, okay. Well, thanks for that. There are one or two other questions there that we will just revert. There's one or two very specific, I suppose, sector specific questions. So we will revert on those ones. So you can be assured that we will come back to you on that. So I think, unless, and I might just hold it there for 30 seconds just to see if there are any other questions that come through that I haven't seen. Okay. So we might just, at this point then, so we're coming up to 5 to 1. So I mean, we wanted to keep it under the hour. So I'm going to bring it to a close. So I suppose the first few things, just again in terms of housekeeping. So we will be sharing the recording of the session, and also some links, and also a kind of briefing document, kind of, which summarizes some of the kind of points that we touched on today. So, you know, I hope what you've got from today's session is that there certainly are you know, key changes coming down the tracks. There's certainly some complexities, and we are certainly seeing already it from an IFRS 16 transition perspective on leases, and also in certain areas when it kind of comes to revenue recognition. But we are obviously endeavoring to kind of support and to, I suppose, help those of you who are on the call. So please, you will have our links to our details after the call as well. So please feel free to shout out to us and use some of those links to documents as well that we'll share as well after the webinar. So thank you to everybody who has joined us, and talk to you again soon.